In this video, we will discuss some ratios which are important in understanding the common stock valuation. First, the expected rate. Now, the expected rate of return is applied both to preferred shares and common shares. Let's take a look at the preferred stock example. The formula is pretty simple. It is the rate of return that investors are willing to pay if they want to buy a preferred share of a particular company. And the formula for this is the annual dividend that they will receive divided by the market price. So, in the example on your screen, if the market price of a preferred share is $75 and the company pays an annual dividend of $5, the expected rate of return would be the dividend divided by the price you are paying. So we're paying $75 to buy the preferred share from the market. And in return for that, we would be receiving $5 in dividends. So the ratio would be 5 divided by 75 equals 6.67%. Now the principle remains pretty much the same for shareholders, but with an added difference. The difference is the dividend would be counted for 1 year from now. So that is going to be D1, not D0, D1. We already know how to account for D1 when we are only given D0. That would be D1 equals D0 times 1 plus G. Anyway, going back to the formula is D1 divided by the market price plus G. G is the growth rate, the internal growth rate of the company. So in the example before you, the market price of the stock is $90 and the stock pays a dividend of $1.12 and the growth rate is 13.6%. So now that we have all the information needed, we plug in the dividend info, the market price, and the growth rate. So we arrive at an expected rate of return of 14.8%. So remember, the difference between the preferred stock expected rate and for the common stock, it would be the dividend for year 1 plus there's going to be an added growth rate at the end. Next, price earning ratio or PE ratio as it is known in the industry. It is a pretty simple ratio. PE, price divided by earnings. So what price? It is the market traded price. Whatever the stock exchange says the price is what we will use for this computation. So the market price divided by earning per share. But what does this ratio mean actually? This ratio is an indication of how much more the investors are willing to pay for a slice of this company's pie for every dollar of earning or every dollar of profit that the company declares. So the higher the ratio, the higher the appetite of the general market to get the ownership of that company. Generally speaking, a higher ratio indicates that the investors believe that the company has higher growth prospects. Similar to the PE ratio is the PB ratio, the price by book value ratio. So as the name says, the ratio is pretty straightforward to compute. It is the market price divided by the book value. But what does this ratio mean actually? This ratio means how much more we are paying to acquire the shares of this company in comparison to the original shareholders. So in the example before you, the PB ratio is 3.16 times. The X here stands for times. So that means that the general market investors today are willing to pay more than 3 times than what the original shareholders paid for the shares of this company. And the original shareholders are those who got the shares from the primary market, generally through an IPO. In this ratio, a higher value indicates that the investors believe the company to have better growth prospects. Next, we have ROE, or return on equity. This one as well is a very simple and straightforward ratio to calculate. It is return on equity. So what is the return? the return is net income after tax. And equity is the total common equity. The keyword is total. That means that both the shareholders' equity and the retained earnings will be taken into account here. Investors are always interested in maximizing their ROE. Remember that the duty of a firm's management is to maximize the shareholders' wealth. As a result, management's performance itself is often appraised by how much ROE they can generate for their investors. But there's a little trick here. ROE can be artificially inflated if the company uses too much debt. Because debt is not taken into account in ROE computation, if a company can rely on external financing by borrowing and generate extra profit, that would result in a high income. But the equity of the company would not increase. As a result, the upper portion of the ratio would go up, but there would be no change in the bottom part. As a result, the ROE would go up. So that is something that the investors of the company would welcome. Except a higher amount of debt also brings with it extra amount of risk of default. So it is a double-edged sword. Nonetheless, ROE is a good indication of how much return the company's owners are receiving for their investments. So as I mentioned, higher degree of debt or higher degree of leverage brings along with it extra number of risks. There is one ratio which gives us an indication of how much indebted, how much debt reliant the company is, and that is the simply named debt ratio. This ratio is a ratio of the total debt that the company carries on its balance sheet in relation to its total assets. In the example given before you, Home Depot has a 53% debt ratio. Lastly, let's take a look at beta. The Greek alphabet beta in the stock market is one of the most popular indicators of the riskiness of a particular stock. A beta value of more than 1 indicates that a stock is more volatile than the market. That means, say for example, a stock has a beta of 1.25. That means that if the general market moves by 1% in one particular day, that stock would move up by 1.25%. If the beta is less than 1, it means that the stock is less sensitive to the general market trend. Say, for example, a stock has a beta of 0.8. That means if the general market falls by 1%, this stock would fall by only 0.8%. So it is less receptive, it is less sensitive to the general market conditions. And because of this higher sensitivity, high beta stocks are considered to be riskier, but at the same time, they have the potential for higher returns. Low beta stocks are considered less risky and are oftentimes called defensive stocks. In the table before you, you will receive a matrix for the different interpretations of different values of beta. Let's go through them one by one. Case number 1, a negative beta. A negative beta indicates that the stock goes into the opposite direction compared to the benchmark index. By the way, what do we mean by the benchmark index? Every market has some kind of a benchmark index which captures the general trend or the general performance of the entire market. For the US, the common benchmarks are the S&P 500, the Dow Jones Industrial Average, which is also commonly just known as the Dow. In the UK, the FTSE, FTSE 100. In Germany, DAX. In Malaysia, FBMKLCI. These are indices which describe the general performance of the entire local market. So if our stock has a negative beta, it means that it is performing in the opposite direction of the index. So let's say we have a -1 beta for a particular stock. That means if the S&P 500 goes up by 2% on a particular day, our stock would go down by 2%. It is moving by the same amount, but exactly in the opposite direction. It is extremely rare to find a security like that. Okay, next is zero beta. A zero beta indicates that our stock is more or less uncorrelated, or it has nothing to do with the benchmark movement. Finding a stock like this is also relatively hard, but there are some fixed yield assets in the bond market which are relatively unconnected to the movement of the stock market. So it is possible to find some assets which have a beta very close to zero. Okay, next case, a positive beta that is less than 1. So in this case, the movement of our stock or asset is generally in the same direction. Why same direction? Because the sign is positive, but the value is less than 1. So that means it is not moving in the perfectly same amount as the general market, but nonetheless, the direction is the same because the sign is positive. But what happens if the beta is exactly 1? In that case, our asset is performing exactly, absolutely exactly the same as the benchmark index. So if the market goes up by 1%, our company will also record a 1% upward movement. But if the beta is more than 1, more than positive 1, it not only means that our asset is moving in the same direction as the index, it is also jumping ahead by a higher margin. So say if the index moves up by 2% and our stock has a beta of 1.25, it would go up by 2.5%. Of course, the same would be true in the event of a downward movement, so you can understand how the stock would be perceived as carrying a higher amount of risk, and associated with it, a higher probability of a return. So overall, from this matrix, you get an idea of how useful it is to rely on the information derived from the beta value in determining the prospect of investing in a particular stock, and also deciding whether or not to include a particular stock in your investment portfolio. That is why beta is a very popular and extremely important measure.